Do you know that order block is not the only institutional reference point that the institution make reference to? Do you know that order block is not the only POI, that's point of interest, it's not the only AOI, that is area of interest, that the price always come to pick order from, and whereby you can be able to take your trades from those points and make good profits? What if I show you an institutional reference point that works most of the time? Okay, and this reference point is called the fair value gap. So in this video, I'm going to be sharing with you traders how to be able to identify a fair value gap, how to be able to make use of fair value gap in your trading. So you want to make sure you watch this video to the very end. Hi YouTubers, this is Mr. Promise right here from Green Promise Institute of Trading, aka Institute of Liquidity. And traders, as you all know, this is the Forex Evangelist, world-class financial market analyst, institutional trader, and the mentor who mentored your mentor, guys. Now guys, quickly, you can do well to subscribe. It's not by force anyway, but if you subscribe, at least it could make sense, because this is going to actually help the algorithm to boost this video and recommend it to traders that this is going to help. Remember, Emeka FX, Ebuka FX, no they hide updates for your fellow traders, guys. Share updates, guys, share updates. Okay, so now I brought you this update that to share to you. Now let's get down to the chart and let's understand this particular reference point. Okay, so quickly, this is just the idea behind the formation of fair value gap. This is the psychology behind fair value gap formation. Every single time, okay, let's say we're in a bearish trend right here and price kept breaking structure, now retracing for a continuation of the trend, possibly like this, and broke structure, you might say that there are times whereby price is going to create a 3 candlestick formation like this. You see a candle 1 like this, a candle 2, and sorry, I use this as my candle 3. The reason why is, now there are times whereby it may not really form just like this. That's how I want to explain it like this. Now all you're going to see is you're going to see 3 candles, candle 1, 2, and 3. Now candle 1 is going to donate its wick. Candle 3 also is going to donate its wick. Now the 2 wick, these 2 wicks, they must not touch each other. The wick of candle 1 and 2, they must not touch. Okay, if not, that's an efficient price action. Okay, so but these 2 wicks must not touch each other now, so it must leave a space in between them, and that's the reason why fair value gap is a type of imbalance. So what price is doing is, now all we're going to do is we're going to mark from the wick of candle 1 right here to the wick of candle 3 with a horizontal tool, a rectangle tool rather, and we draw into the future. Now what price is going to do sometimes now is this space, the body of this candle 2 right here, okay, that we marked, now there's an imbalance inside of it. Now what price is going to seek to do sometimes is price could come down to do what we call a rebalancing, to fill in this imbalance right now, and price will come down, trigger from this fair value gap right here, and keep trading like this, guys. Can you see that? Hola guys, and that's a fair value gap in active use right there. Now there are times whereby in a bullish scenario also like this, okay, in a bullish scenario like this, now you might see this, now you might see that all the colors, all the candle color may be the same like this, okay, candle 1, candle 2, candle 3 like this, just bullishly going. Can you see this? See how this candle right here, this candle, one of the candles donated its wick, this other third candle donated its wick, and the candle at the middle, which is the candle 2, the body of this candle, guys, is our concern. Now we must make sure that the wick of our candle 1, okay, we must make sure that the wick of candle 1 and candle 3 do not touch. If the wicks, if they touch each other like this, now that's an efficient price action. Can you see this? That's an efficient price action. So there is no more imbalance right there. What we are looking for is, we are looking for imbalance, guys. We are looking for imbalance. We are looking for those areas whereby price have not traded into them. The why ideology behind this is, now if price leave an imbalance, if price leave a gap in the market, price is going to always come back to fill that gap. It is just the way the market, the algorithm is fashioned to work, guys. Okay, yeah, so that's just it. So if you get this now, the how to draw your fair value gap, now you must understand that the 50% of the fair value gap, okay, we draw from candle 1 to candle 2 the week, and we pull it into the future like we said. and see how price can come into it and trade into it, and from there guys keep trading bullishly, so we catch plenty pips here. So we were saying that the 50% of your fair value gap, okay, you can use your Gann box tool, maybe your Fibonacci, draw from that week right there to the other week, and the middle in which they meet, it is called the 50% of your fair value gap, and institutionally speaking we call it consequent encroachment. We call it consequent encroachment. So 50% of your fair value gap is called consequent encroachment, guys. So how do we engage the use of fair value gap? How do we engage the use of fair value gap in trading? Now there are two ways we engage this. We either take risk entry. Now risk entry, this is just risk entry. For instance, I was looking to sell this right here. So when price was coming to my POI right here, when I got a fair value gap like this and price is coming into it, all I'm going to do is risk entry is you can place it maybe at the tip of the fair value gap or maybe at the 50%, depending on how your risk tolerance. Okay, now please look at this, guys. This is the wick of this other candle, mind you. Now the wick of this candle right here, look at this, the wick of this candle. We're going to draw it now out like this. The wick of that candle that formed the fair value gap, this candle too, that the body formed the fair value gap. Okay, that is where our stop loss is going to be under like this. Then we what? Then we enter from maybe 50% or the tip of this fair value gap. Either I enter like this, okay, or I enter at the 50%, and guys, I catch this. Now this is risk entry. Please take note of that. Now confirmatory entry now is for risk entry is for higher time frames. Okay, when you want to do maybe for bigger time frames, you can do risk entry for bigger time frames, but it's not advisable to do risk entry for smaller time frames, like lower time frames, lower than 1 hour, and so please do not do that. Okay, so for maybe 2 hour, 4 hour, you can do daily time frame, you can do risk entry on fair value gap. So now confirmatory entry is just simple, guys. Now at the fair value gap right here, what we are going to do is we just enter at this fair value gap. We just want to see that price give us a shift of structure right here, a lower time frame shift of structure, and we enter at the fair value gap inside of that lower time frame shift of structure, and that is just confirmatory entry. And we ride the trade to the downside, guys. Ride the trade to the downside, So that's just confirmatory entry. So quickly, let me take you to the chart and let me show you traders how this thing works. Now look at this, guys. This is currently 2 hour time frame, and this is a fair value gap. And you see this, my candle 1, candle 2, candle 3, and there was a space in between there. I draw from the space from the wick of candle 1 to the wick of candle 2. Okay, that's the body of candle, sorry, to the wick of candle 3, that's the body of candle 2, and I drew it into the future. And you see how price did. Price came, traded into it. Look at this, price traded into the fair value gap, and kaboom, guys, you'd have made all of this move. That was a beautiful one right there, guys. Okay, so how would you have engaged a trade like this? This is 2 hour time frame. So 2 hour time frame, like we said, you can do risk entry. Fair value gap risk entry is allowed for maybe anything 2 hour time frame or thereabouts. So let me just show you guys how I would have engaged this now. So risk entry, I would have taken it from this fair value gap right here, just below the candle 2. Can you see our candle 2 right here? So this can be your what? This can be how you can take this. So risk entry like this, and you target. So either you take from the tip of the fair value gap or the 50% of the fair value gap, and this is risk entry on how to engage the fair value gap. So what about confirmatory entry, guys? So if I want to take a confirmatory entry now on this fair value gap, okay, now I'll go down to a lower time frame. For instance, maybe I'll use a 15-minute time frame at that particular zone, guys. Now when I go down to a 15-minute time frame, all I'll just do is I will just frame that same trade on 15-minute time frame at the fair value gap right there, at the fair value gap inside of my shift of structure at that zone. And you see this is my 15-minute time frame. Now we'll just frame it at a fair value gap right here. Can you see that? So now it means this now is now going to be my what? My entry, guys. And kaboom, guys, do you see that there was little or no drawdown, guys? And my god, so this trade went perfect, guys. So this is confirmatory entry, guys, because this was my shift of structure right here. Perfect, guys. And can you see the shift of structure return to fair value gap right here? And kaboom, guys. So I hope you guys got value from this video, guys. I hope this was really helpful.